Assalamualaikum everybody. So today we're going to learn chapter 3, which is accounting classification and accounting equation. The learning objective of this chapter is to define and explain asset, liability and owner's equity. Define and understand the use of the accounting equation in analyzing transaction. Define revenue and expenses. Show the effect of the transaction on the accounting equation. Look at this slide that portrays the cartoon. Based on the dialogue, 84% of our losses are due to accounting errors. So you can see that they're having losses because of accounting errors. That's what we're learning in this chapter. To prevent those accounting errors by doing correct classification of account. Okay, so in this slide, it's a bit of a summary of this chapter. So in a business transaction, there's gonna be a few classification of account. The first is an asset, second is liability, and the third is the owner's equity. These three types of account will be put in one statement, which is the statement of financial position. There are two more classification of account, which is the expense and revenue. So these two accounts will be put under statement of profit or losses or lost. Okay, so in this slide, we're going to focus on one account, which is an asset. Okay, so an asset is defined as a property or wealth owned by a business. You can see that asset is divided by two categories, which is current asset and the second one is non-current asset. So current assets are assets that are either cash or those that can be converted into cash within 1 year. So to put it simple, it's an asset that you can gain within a year. So for example, it's like account receivable or debtors, cash in bank, cash in hand, prepaid expense, accrued expense, or notes receivable. So they are an asset that you can gain within a short amount of period. So for example, cash that you use to buy things. So the second category is non-current asset, which is an asset that acquires or bought not for resale but to be used in the running of a business. It's an asset that you own to run or operate the business. This asset can be within your business for more than a year. So it has a useful life of more than a year. So this type of asset is also not easily converted into cash. Okay, so they are divided by three categories: tangible non-current asset, intangible non-current asset, and investment. So non-current asset, you can see, for example, is like this building, which used to operate the business and can be operate for more than a year. Okay, so the next slide, see, tangible non-current asset, for example, is like land, building, machinery, and anything more. It's an asset that can be used to operate the business. Intangible non-current asset is like franchise, goodwill, trademarks, and patents. So it's like this, Adidas. It's a brand that urge buyers to demand more of your product since you are well known. That's also an asset. So lastly, the non-current asset is investment. So it's a quote or unquote investment and fixed deposit. Next. Okay, so this is the summary of assets. So asset is divided into two, which is current asset, which is can be gained and converted into cash within a year. Non-current asset, which is used for operational of the business more than a year. And it is divided into three categories, which is tangible non-current asset, which is an asset that can be touched and have physical substance. Intangible non-current asset, an asset that doesn't have a physical substance and cannot be touched. Lastly is an investment. So investment is like when a company or a business buy shares from another business. In return, they will gain a return. So that return will be your asset. So next account is liability. So liability is a financial obligation of the business to external parties. Simply say it's a debt, a business debt to another entity, usually banks or other businesses. Okay, so just like asset, liability is also divided into two categories: current liability and non-current liability. So current liability is an amount owing by the business that is to be paid within 1 year. So it's a debt that the business has to pay within 1 year. For example, like short-term loan, bank overdraft, payable, notes payable, and everything else here lah. So for non-current liability, it's an amount owned by the business that is not repaid within 1 year. So it's a debt that the business has to pay longer than a year. So usually the amount will be huge. For example, it's like long-term loans, mortgage, on-premise, or debenture. So in this slide, we're focusing on the summary of liability. So liability, which is a debt, only divides into two, which is current liability, a debt paid within a year. Non-current liability, a debt that have to be paid more than a year. Okay, so next, we'll go into owner's equity. So owner's equity is divided into four categories, which is capital, expenses, revenue, and drawing. Okay, so in this slide, we're going to go into detail about owner's equity, which is a financial obligation of the business to the owners, among which the owners have invest in the business. As I stated before, owner's equity has four transactions below it. The first one being capital, which is a resource supplied by the owner. So when the owner of the business pump in money or provide properties to the business, this will increase the owner's equity of the business. Okay, the second is revenue. Money or some equivalent value that a business receives in exchange for providing goods or services or through investing capital. Revenue, income, hasil lah. When revenue is bigger than expense, the company will receive a profit, and this will increase the owner's equity. So the third one is expense. Expense is a cost of operation that a business incurs to generate revenue for the business growth. So expense is like paying salary or paying bills to the paying electric bills. So when expense is bigger than revenue, this will cause loss to the business, and this will reduce owner's equity. Lastly is a drawing, which occurs when the owner takes whatever asset of the business for his own use. So when the owner of the business takes, for example, uh, money to pay for his children's school tuition, that's a drawing. So this will reduce the owner's equity. Okay, so next we're going to go into the owner's equities equation. So we can see that owner's equity equals to capital plus or minus, plus if it's a profit, minus if it's a loss, which profit is due to revenue higher than expense, when loss is due to expense bigger than revenue. And you deduct drawing since it's taking out the assets of the business. So when this is put together, you will get owner's equity. Okay, now we have finished the accounting classification part. Now we're going into accounting equation part. Okay, so this is the second part in the chapter. Okay, accounting equation. Accounting equation is the foundation of accounting. It explains the relationship between asset, owner equity, and liabilities. Basic equation associated with double entry accounting. The relationship between the assets and equities of the business can be expressed by the following equation. So, the equation are asset equals to owner's equity plus liability. So this is the basics. So this is the basic accounting formula. So using this formula, you can also do the double entry bookkeeping, and they also have to be balanced. They can also be expressed as two parts. Just a moment. Okay, so the left and the right side have to be equal. So if this is a 1, and the other side has to be a 1 also. So if this side is 0, this also has to be 0. Okay, you have to maintain the balance. Okay, next. Okay, so next in this slide, you can see that resource in the business equals to asset, and resource supplied by the owner is owner's equity. So when you say supplied by the owner, it's a capital, modal business lah. So when you expand that equation, so the resource in a business is an asset, resource supplied by the owner is owner's equity, and you plus with resource supplied by others, liability, the debt. So this is the business transaction. Generally, this is the business transaction. So when you expand more, when the accounting equation it's a profit or loss, you can see that when a profit it's a plus, when a losses it's negative. When there's a drawing, you always minus the drawing because it reduces the asset of the business. So this slide explains deeper on how to getting the profit or loss. So the difference between profit or loss is that you gain a profit when the revenue is bigger than expenses. You gain loss when the expenses is bigger than the revenue. So if you replace the profit and loss, so this is the general accounting equation. Assets equals to capital plus revenue minus expenses minus drawing. So these four are the elements in owner's equity. Then you plus with the liability. And then you get the expansion version of the accounting equation. Okay, so in this slide, as it was explained in the first slide, so statement of financial position. As I have stated, in the financial position, there are three accounts, which are the assets, liability, and owner's equity. So the equation that we learned just now, that equation is being used for creating this statement. See, the statement itself has detailed expression of the accounting equation. Let's look at an example of the statement. See, you can look at the slide later on. So it's an current asset, and fixed asset is non-current asset. You will get the total asset, and you can see that the liability plus the owner's equity, you can see the ending balance, total liability and owner's equity is equal to the total asset. That's what I mean by balance. You have to keep the equation balanced. Okay? That is all for this chapter. Thank you.